In this video, I'd like to talk about how to incorporate a currency investment into your stock portfolio. You are a traditional investor in stocks and you want to diversify in order to mitigate the risk of your all stock portfolio. You could incorporate currency investments. You could invest in currencies as well. So incorporating currency investments into a stock portfolio can enhance diversification. It could hedge against risk and potentially increase returns. So currency investments are generally separate from traditional stocks and bonds, but can complement them by offering exposure to the global markets and global economic trends. So here's how to incorporate currency investment into your portfolio. I want to highlight how you could then, incorporate a currency investment into your portfolio. Number one is you use currency exchange traded funds. Currency exchange traded funds. It is known as currency ETFs. So currency ETFs are one of the most straightforward ways to gain exposure to foreign currencies without directly trading in Forex. These ETFs track the performance of specific currencies or a basket of currencies, offering liquidity and ease of access. For instance, you can invest in ETFs that track major currencies like the dollar, the euro, or the yen, or even emerging market currencies like the naira. This approach allows you to gain exposure to currency movements alongside your stock holding. And most of the times, these they don't tend to correlate. So you will gain one way or the other. If there's a fluctuation in stock prices, your currency investment could be available to cushion the effect. Number two is diversify with currency mutual funds. Apart from currency, ETFs, exchange traded funds, you equally have currency mutual funds. So in this case, currency mutual funds, pool investors' capital to invest, in foreign currency markets. These funds are managed by professionals who make decisions about the best currencies to invest in, based on the economic and market factors. And so currency mutual funds are suitable for investors who want to add currency exposure to their portfolios, but prefer, a managed approach rather than direct trading. Number three is use currency, hedge equity ETFs. Currency hedge equity ETFs. So currency, fluctuations can impact international stock movements. And currency hedge equity ETFs are designed to neutralize the effects of currency, fluctuations, allowing investors to focus on the performance of the underlying stocks. For example, if you invest in European stocks through a currency hedge ETFs, the ETFs will adjust for changes in the euro's value relative to your home currency, to your domestic currency. And this strategy helps mitigate currency risk when investing in international market. You need to hedge against this kind of risk. Number four is direct Forex market investment. You could choose to invest directly, in Forex if you have the skills, if you have the risk appetite. If you're sure you will not blow your accounts, it's a very good proposition. And so for more advanced investors, directly trading in the Forex markets can provide exposure to currency movements. This involves buying and selling foreign currencies with the aim of capitalizing, fluctuations and in exchange rates. Forex trading can be used as a standalone investment strategy or combined with your stock portfolios to hedge against currency risk. You could invest in foreign currency as a standalone investment. You could use it as a tool to hedge against, portfolio fluctuation. However, it requires more knowledge and experience as the forex, the forex market is highly volatile. Please, if you lack the experience, don't just invest in forex alone. Make sure that you equally have investment in stocks, all right, or else you end up blowing your accounts, which will which is not a good experience at all. All right, that's why you have that leeway, that advantage of investing in different asset classes. Please don't like this video, all right, and subscribe to this channel. It will encourage me a lot. So number 5 is invest in international stocks with currency exposure. Invest in international stocks with currency exposure. When investing in foreign stocks, you are directly or indirectly exposed to currency risk. That's one funny thing about global investing. That currency risk is always there for the investor to tackle, to battle with. So, for instance, if you have investment in Japan or maybe in a Japanese company, and so fluctuation in the yen, could affect the stock's performance. This exposure can be used strategically to benefit from currency movement. If you anticipate a strengthening of a foreign currency, you might consider investing in stocks from countries with appreciating currencies. Whenever there's an appreciation in a particular country's currency, I want to benefit from it. You could invest in the country's stocks, because as your stock price appreciates, when you sell and you are converting the money into your into your own currency, you discover that you have a larger level of returns. Number 6 is hedge against risk. Hedge, hedging. When it comes to hedging, currency risk is an important factor you need to learn to adopt. Actually, it's an important consideration you need to take into account. You see. So number 6 is hedge, currency. If you have significant exposure to foreign assets, hedging against currency fluctuation can be beneficial. So you need to hedge against currency risk. So this can be done through currency forward contracts, options or futures. These are a bit complicated than normal investment. We don't even have them in our Nigerian stock market. We don't do contracts, we don't do options, and we don't do futures. Probably in the future, as we advance, we may end up incorporating these investment strategies. So hedging strategies, help protect your portfolio from adverse currency movements, which could impact your international, stock investments. So hedging is a more advanced strategy, but can provide protection in a volatile market. It's an advanced strategy. Me personally, I've never done hedging before because it's not really available in the Nigerian stock market. I invest essentially in the Nigerian stock market. So when it comes to hedging, put options, call options, forward contracts, all those ones are very common in advanced economies like the US market. They do all those things, but we're not really. We only study them here, but we don't really practicalize them in the country here. So when I talk about them, I'm talking barely on a theoretical basis, not on a practical basis. So number 7 is monitor economic trends and central bank policy. You monitor economic trends as well as central bank policies. So to effectively incorporate currency investment, it's essential to monitor economic factors and central bank policies that influence countries or a country's currency value. And so interest rate, inflation, and economic growth, all impact currency movements. Keeping an eye And these factors can help you anticipate currency trends and adjust your investment accordingly. That's it. Number 8 is allocate a portion of your portfolio to currency. Just take a particular portion, maybe 5%, maybe 10%. You allocate it to foreign currency investments. And that should be a sizable level of diversification, particularly if you're not quite experienced in the entire strategy. You could devote 5 to 10%, and so you balance the allocation appropriately as time goes on. You rebalance as time goes on. Number 9 is consider global events and risk. You consider global events and inherent risk in the global economy. So currency values are influenced by global events, including political instabilities, economic crisis, and geographical or geopolitical tensions. So these factors can create volatility in currency markets, which in turn impacts your stock portfolios. And so especially if you hold international investment, stay informed about global events, will help you make timely decisions when it comes to adjusting your portfolio. So stay informed, and stay updated so that whenever an event is about to occur or has occurred, you could then adjust your portfolio accordingly. So incorporating currency investments into your stock portfolio, can enhance diversification. It offers hedging opportunities and, provide exposure to global economic trends.